Okay, everybody, I've got a great one for you. 6 retirement killers to avoid at all costs. I have fun doing these videos and coming up with topics all the time, but boy, when you guys send me some ideas, I have fun with them. So here we go. Let's start with my first one. My first one is failing to have an income plan. All right. Look, here's the thing. It's not easy to go into retirement and just flip a switch and start spending more than you make. So the idea of an income plan is utilizing your resources as efficiently as possible for an enjoyable retirement. Every one of you has a different amount of IRA money, Roth money, after-tax money, a different amount of pension income or no pension income, Social Security. I know people with no Social Security. Everybody has a different puzzle, and it's all about trying to create the most efficient way with your resources. So guaranteed income should pay only those base living expenses in a perfect world. Okay, some people retire with huge pensions and huge Social Security. They can't even spend that money on fun stuff. Totally get it. Some people retire and only have a tiny little bit of Social Security, and they're relying on their savings to fund retirement. That's easier to fix, actually. So in a perfect world, guaranteed income, that's Social Security, pension income, and those guaranteed income annuities, they should only pay your base living expenses. Then there's enough savings to cover emergencies and fun. You have to have balance in retirement. You can't go into retirement with just income or just savings. I guarantee you, I've met people in both those situations, and neither of them were comfortable, no matter how much money it was. Okay. Be forced to pay taxes only on income needed. All right. That's what we're talking about here. If you have way too much income and you've got all this stuff coming in, you're paying taxes on it. And the people that I've seen in these situations are paying high into the 20+% tax rates, and they don't need any of that. It's very inefficient. Okay. So don't go out there and invest on more income producing investments when you have great pension income. Also factor in that required distribution that's going to start coming in at 73 now and later at 75. Safe and stable investing is most important, where withdrawals are going to be focused. And for most retirees, that's IRA money. So a lot of the safe investing gets shoved up into the IRA for most retirees, because that's where all the withdrawals are coming from, and that's where stable investing really shines. Okay. Then when you look at your Roth, you're going to look at this as your heirs' favorite money. So if you do actually care what your heirs get, growth for your heirs is great here. Okay. Good long-term stable growth type investing. And then all the other money that you have, that non-qualified after-tax savings, you've got to start looking at that as more of a tax-efficient investing style over there. Okay. Everybody's got different resources. It's just making the best of the resources that you have. That's what an income plan is. The next one, number 2, using unrealistic investment return assumptions. I see this all the time. I hate the Monte Carlo. I'm a statistician geek. I love spreadsheets. I think the investing assumptions out there are ridiculous. I think even the professionals are misguided on what they're going to see in the future. Okay. So I'm going to show you a couple of examples why what you are probably using is completely flawed. Okay. And there's no trick to this. It is black and white math, and it is very simple. And I do a lot of education on this type of stuff when it comes to investing. So here's the scenario. You have $1 million. You're not withdrawing anything. So we're in our wealth building years. Okay. We throw it all into the S&P 500. I use what I call the modern stock market in this example. When I say the modern, at the turn of the century, that's when we digitized all trading. Okay, you don't have to call a broker anymore, and that happened about the turn of the century, 2000 to today. The electronic stock market is real. There's nobody on the floor going, buying and selling, buying and selling. You don't have to call a broker to buy and sell. You can hit a few buttons on your phone now and sell your whole portfolio. Okay, that is a fundamentally different stock market than before 2000. Fundamentally. Think about the pandemic. Think about 2008's crash. Fast and furious, fall. Try calling a broker to sell your whole portfolio in the middle of a panic going straight down. It's impossible. They're hiding under their desk. How do you sell your portfolio if you can't get a hold of the broker to sell it for you? Do you see the difference here? We have record-setting volatility since we've digitized everything for very obvious reasons. Because we can see our news on our Twitter feed and hit another button and sell our portfolio if we want. All right. We can be more emotional about our buying and selling in the stock market. We can act on it faster. And that's why we see much faster ups and downs in the stock market. So there's one part of our assumptions that we have to be careful about. You want to go all the way back to 1922 and use that's hogwash. We are in fundamentally a completely different stock market than the 20s, 30s, 40s, 50s, 60s, 70s, 80s, and even the 90s. So be careful about what markets you are using. We have way more turbulence in our markets now than we ever did before that. So here's your example. $1 million grows to $2.5 million. The annual compound return that the S&P 500 has done since 2000 to today, well, through 22, is 4.23. That's it. So those of you using 6 and 8%, or that Dave Ramsey using 12%, holy cow, please be careful, right? Because here's earning 4.23% every single year. And oh, hey, we ended up with the exact same amount of money. Just to prove it to you, all right? So the stock market really has only earned 4.23%. And again, you can do compound monthly, you can do compound daily. There's a different number for each compound version you're gonna do. We can do a simple interest number if you want to, but the math is different for each one of those. I just went to compound annually because I'm showing annual numbers. That's it, all right? Told you I was a math geek, talking over half the heads. I'm fine with that. I want you to know that when we are building wealth, when we are growing our money and we are not taking out, these are the same. The stock market goes up and down and up and down, up and down, but it averaged 4.23%, and earning 4.23% gave us the exact same results, right? Should totally make sense, right? So now when we start playing around with the numbers, and I run into engineers all the time, I love working with engineers. My dad's an engineer. I grew up in an engineer's world. It makes sense to me. So then we start modeling and figuring out, okay, well, I got X amount of dollars and I can pull this money out. And now I'm going to be just fine in retirement. So here's somebody with $1 million, and I'm going to take 50,000 out every year. Okay, that's a lot of money. So I go back to that stock market, same S&P 500 from 2000 all the way to 2022, and I ran out of money in 2018. $1 million, 50,000 a year coming out, I ran out of money. Not good. But if I ran this calculation on earning 4.23, I still got 700 grand left at 87 years old in 2022. Look, if you're running your assumptions off of flat growth, whether it's 6%, 4%, 2%, I don't care. If you're going to invest in the stock market, you're going to have years that are up, you're going to have years that are down, and you have to understand how that variability changes the performance. Because I just used the same 4.23% stock market and the same fixed 4.23 return, and we got completely different results. So if I'm running my math and running my assumptions on just 4.23, that's a problem. If I don't factor in these withdrawals and I say, well, hey, the market did great building my wealth, it should do a great job when I'm withdrawing too. No, it doesn't. Turbulence is your enemy when you start withdrawing. Okay, volatility is horrific in your portfolio when you're withdrawing, especially at a rate like 50,000 a year. Be careful about your assumptions. The next part of this is just taking too much risk with your portfolio. Number 3, too much risk with your investments. I run into people that are so confident in their stock market investing because they did a great job of building wealth. Well, you saw what happened when you just began withdrawing. So the higher your dependence on your portfolio for income, the less it should be left to chance. If you don't need your money, throw it all in the stock market, keep building your wealth. I don't have a problem with that. But if you need your money, you have to change your understanding of how the stock market works. You have to understand the math. The larger your withdrawal rate, the greater the effect of volatility, okay? Deposit into volatility. I'm fine with it. Build your wealth with volatility. I'm good with that, okay? But withdraw from stability to maintain that wealth. You've got to make that transition as you go into retirement. Number 4, being so miserly you can't enjoy retirement. Look, I meet people all the time that are frozen. Again, you can't go all your life being conservative, making and spending, spending less than you make every day of your life, building your wealth, saving money. Every paycheck goes into savings, and just flip a switch and start spending more than you make. It's very hard for people. But there's a lot of things that can be done by good advisors that can sit down and help you understand your money. The first thing is reduce the roller coaster in the portfolio, because anybody that has all their money in the stock market, that money is not real. That's the way they mentally look at that money. It's not real. I've never been able to touch it. I only put it in there. I never take it out of there. It's a different value every time I look at it. I had somebody telling me that they looked at it at midday and it was this much, and they looked at it at midnight because they were worried about the stock market, and it was about $10,000 different. She looked at me and goes, I freaked out. It changed by $10,000 in minutes in my head. I don't know how this works. So that money is not real if it's bouncing around so much. You got to find ways to make it more real. Stable investing helps with that. And the other thing you have to do is to admit that house you own free and clear, that'll be fine for paying for long-term care. Let's be honest, most long-term care insurance policies aren't going to pay out anywhere near as much as the equity you have in your house, okay? So now, all of a sudden, we don't have to save all this money for a rainy day because we got that house as our backup for long-term care. That helps people mentally. Then we need to start doing math. We need to start realizing this money is real. So look over at the chart on the right-hand side here, maybe your left. It all switches around on the video. So your current age example here is 65. You have $1 million in savings. Divide that by how many years you have to 100. $1 million divided by 35 is $28,000. And what that number is if you don't earn a thing, if the money's in $1 bills all over your floor, every morning you wake up, roll out of bed, and you do snow angels in $1 bills, okay? No risk. Well, other than fire and all those things. Look, no risk. You can pull $28,000 out for 35 years. 28,000 $1 bills you can pull out of that pile every single year and not run out of money till you're 100. If you start seeing things like this it doesn't fix you right away, but it will help you with guidelines on how much money you can spend. And that way, if you're invested, the money is going to grow. You're going to be a year older, and every year you're going to do this math, and you're going to see that number get bigger every year. That's cool. And it really does help you find ways to spend this money. So that'll help break you from that habit. Number 5, giving or spending too much money too soon. We have to be careful. We have to be careful. We have to plan this out. We can't just wake up and spend hundreds of thousands of dollars in the early years. I have plenty of people that come in and say, look, 60s and 70s, I'm going to go, spend. And that's wonderful. Plan that out. But then you throw in buying a second home. You throw in giving money to kids, giving money to charities. You start boosting even a higher spending rate by doing those big purchases, those big one-time things. That's when we get hurt. So here's the scenario here. This just somebody with that $1 million comes in and starts taking $2,000 a month out and grows it for inflation, gets a little bigger withdrawal rate every single year. It all works out just fine. And that's with 100% in the stock market, which I told you was terrible to pull from. All right. It still worked out just fine. But here, what if we modified these to what a lot of people want to do is spend a whole bunch of money in their first few years of retirement. So I started with a $50,000 withdrawal. Then I threw a $250,000 for a big purchase. They wanted to buy the $250,000 motorhome, right? And then 60,000, 65, and then it dwindles down, and then they shut it off. I'm going to 2,000 a month. I'm pulling out of there, and I grew it to inflation. So it actually went lower than the previous one to help make up for it. But we pulled out $1 million as opposed to the 827. Right. So we just had that extra 200 grand we pulled out in the early years, and we ran out of money very quickly. That's the problem. So we've got to be careful, especially with the turbulence in the market with withdrawal rates like that. It makes it very unpredictable. And when you burden your portfolio that much that early, you have a lot less to work with later and a lot of making up to do, and you keep pulling from it. So be careful about what you're doing too early. The other thing I want you to think about is inflation. And the cool thing that kind of makes my brain see it is let's look back to look forward, right? So Social Security, 10 years ago, the average Social Security check was $1,200. Can you live on $1,200? What do you think your Social Security check today is going to look like 10 years from now, 20 years from now, 30 years from now? And that's why I'm saying you look back. Look at 30 years ago. Are you going to be in retirement 30 years? Somebody that retired 30 years ago, the average Social Security check was only $652, which I have a client with a $652 check for Social Security. Boy, does that person need a lot of savings to make up for that income not paying really anything anymore. So we have to be careful. And people say, oh, but we get that cost of living adjustment. Oh, yeah, that was real nice the last year or two. But what about the 10, 15 years before that you got a 2% raise at best, and Medicare jumped its cost more than that, right? That cost of living adjustment is not what you're going to really fund your retirement on, trust me, because that cost of Medicare keeps going up. We've had a couple of years where they've adjusted Medicare, they've adjusted the IRMA on there and moved things around. And hey, we happen to see some inflation, so we got a bigger adjustment to our Social Security, but the norm is not that. Those of you that have had Social Security for the last 10 years know that that cost of living adjustment does not keep up with the cost of living. All right, here we go. Number 6, blindly believing your advisors. This is hard for me to say. Look, I do a whole class on finding unbiased financial advice, and one of the things I tell people is figure out who you're sitting in front of. There's 4 different types of advisors out there. There's salesmen, there's customer service, there's the investor, doesn't do any planning, just invests your money, and then there's the financial planner. And as crazy as this sounds, they all pretty much charge the same fees. So you've got to be careful. The honest upfront ones that charge that advisory fee that you know what it is, as long as that's all they're charging, good. There's nothing wrong with that. But then there's commissions. We got to understand that there are a lot of commissions out there. The insurance commissions, they're unavoidable. All insurance products pay commissions, whether it's homeowners insurance, auto insurance, life insurance, annuities, all that stuff. It's all commissions. You can't avoid it if you're going to get into that world. So you won't find those fixed annuities or immediate annuities at any dinner seminar because they don't pay a big enough commission. And most advisors won't touch them because they don't get paid enough. That's a bias we have in the industry. Then you get those fixed and fixed indexed, or sorry, those fixed indexed and those fixed income annuities. Okay, those dinner seminar annuities. Those things can pay anywhere from 4 on up. I've seen 13%. That says 4 to 10. But those commissions don't come from your money. So that's a distinction you have to understand. Yes, it promotes the salesman. Right? It says, hey, I've got a shiny object here. I want to sell to anybody that'll take it. So salesmen flock to that business. It doesn't mean they're bad products. It means that there are salesmen selling those and they could care less what your needs are. Okay? That's important. There's plenty of financial advisors. There's plenty of investors. There's plenty of customer service that utilize annuities properly. There's nothing wrong with annuities. But when you get to the securities world, this is where I want people to understand. The commissions that are not disclosed to you come out of your money. Okay, this is so important to understand. Mutual funds especially. Mutual funds, you'll see anywhere from 0 to 5.75% commissions that do come out of your money, and they are not disclosed to you in any way, shape, or form. Okay, very important. Buying and selling individual bonds, I guarantee you somebody's making commissions. They're buying from somebody at 98 cents on the dollar and selling them to you for 105 cents on the dollar and keeping the difference. That's how it's working behind the scenes, and they don't have to disclose that either. Okay, private investments, huge commissions, and they're illiquid investments. So yeah, they really do take it out of your money and hand it to them. Variable annuities, the commissions are all over the board. The fees are all over the board. They're all over the place, but you've got to know why you're getting into that variable annuity. So I want you to be careful about the commissions. I'm okay with advisors getting paid if they're doing their job, but there are a lot of things to watch out for. First of all, one hint. If they're not very thorough in trying to understand you and your situation, you have to observe the questions they're asking. Do they just care how much money you have and how they can get it into their investment? That's a problem. They need to be very thorough and care about everything, including your income and your outgoing. They need to know what your bills are. If you just tell me that you have $2,300 in Social Security, that doesn't tell me anything about you. I know plenty of people that enjoy their retirement on $1,500 a month. So $2,300 is a great income, right? Well, maybe you need $5,000 a month, and that completely changes everything. Okay, double dipping in fees, that should be a no-no. Okay, somebody charging you a management fee, whether it's 1% or I'm starting to see 1.5% is more of a norm out there. It's pretty crazy. So charging that management fee and taking the commissions out of your money by utilizing some of these mutual funds that pull these commissions out of your money. You've got to be careful about this stuff, and you got to pay attention. If they're constantly changing your portfolio every quarter when you go in there, that's a problem. Okay, these high cost mutual funds are hiding so many fees. You've got to keep an eye out. A shares and B shares usually are the big culprits of those. Quarterly reviews that end up in more fees. If every time you go in, they're changing and adjusting the portfolio, I assure you that is not how investing works. They're doing that to make you think they're doing their job, and they're really just making more money. That's all they're doing. So please be careful about that. Do they earn their fees? I want you to really step back and think about that. They're charging you fees. Are they just throwing in a bunch of mutual funds? Do you understand that mutual funds are a portfolio managed by somebody else and they're charging you fees for that? So you have somebody charging fees to hand the money to somebody else so they can charge you fees, right? They should be advising you. Do they reduce the taxation, right? Are they putting you in a good solid income plan and taking advantage of the resources that you have and doing it properly to reduce the taxation? Do they manage your risk properly? Are they meeting your expectations when it comes to the ups and downs of the market? And then do they help your comfort level with your money? Okay, this is how these people should be earning their keep, right? They should make you feel comfortable with your money. And if you don't feel comfortable, you give them a chance, go in. If they're still not doing their job, then it's time to find somebody else. All right. So hopefully that helps. These are things that just are going to kill retirement. You've got to make sure you've got these things in order to have a happy retirement. Okay. So if we can help in any way, I'm always happy to do this. I love this stuff. I had fun creating this little list, and I think it's a really important list, right? Share it with people. Send it to a few friends. There's a little share button down there. Like the video. Comment below if I missed something. You want me to do another topic on something? Give me some ideas. I'll create a new topic for you. I love creating these videos, and I love when you guys give me feedback on this stuff. So if you haven't subscribed to our channel, we're putting new videos every single week, and we're going to keep doing this for a long time. We love it. Let us know if we can help out. Give us a call, shoot us an email. Always happy to help. Thank you, guys. Bye.